This episode is brought to you by Paddle. Don't settle for less when you can have more, MOR, with Paddle, your merchant of record. Eliminate the headaches of payments, grow your revenue everywhere, and focus on what you do best, building your product. Get more revenue with less hassle at paddle.com. Okay, guys, I got a serious update for you. You heard me talk about SEMA and the product roadmap radar. I just caught up with Matt, who's the founder there, and he gave me the latest on what they are building. And my mind is blown. The team at SEMA are taking things to the next level. Built around the core of the product roadmap radar, i.e. code and Jira analysis, they are building agent orchestration across the product lifecycle. Picture this. You hook up this system same as before, i.e. integrate your repository and your backlog, Jira today. From that point, SEMA's agent analyzes the codebase and makes suggestions as to what needs to be done next and what could improve, optimize the product. Then, if those tasks are routine, the agent assigns the task to a coding agent, think something like Devin, to complete the minutia, while assigning the human-in-the-loop task to engineers themselves. What you end up with is engineers focusing on building core competency features while AI handles all the rest. If you're not salivating right now, I don't think you fully understand what this means. But here's what I would suggest. Right now, their product is in a closed beta, and SEMA is looking for folks to sign up for their Product Intelligence Advisory Board. This gives you the opportunity to use the product, give feedback, help shape the future of what's built. Oh, and not to mention additional free usage of the product potentially through the end of 2026. So, if that fits your workflow and toolset, you need to reach out today. Go to codestory.co/nextlevel, NEXTLEVEL, and reach out to Matt at SEMA to learn more and join the Product Intelligence Advisory Board. Again, that's codestory.co/nextlevel. This episode is sponsored by Postman. Postman is the world's leading API platform, trusted by 98% of the Fortune 500 and over 40 million developers. Tap into APIs from 18,000 plus companies to power agents that make smarter decisions. Learn more at postman.com/podcast/codestory. This message is sponsored by MailySearch. Today, search isn't just a feature, it's a cornerstone. And MailySearch gives your users the experience they need with lightning-fast performance, full-text search, AI usage, and multimodal capabilities. MailySearch delivers relevant results in less than the blink of an eye. Use the promo code CODESTORY at checkout to get 2 months free at mailysearch.com. That's MEILI search.com. This episode is brought to you by PropelOff. People take authentication for granted, but it's more than how customers log into your product. It's how you manage your relationship with your users. The easiest way to make authentication your advantage is to use PropelOff. PropelOff is more than just functional. It's powerful. With tools like Managed UIs, Enterprise SSO, robust user management features, and actionable insights, PropelOff adapts as your product grows. And the best part? When auth is effortless, your team can focus on scaling, not troubleshooting. That means more releases, happier customers, and more growth for your business. Save dev time, win over your customers, and propel your business forward with PropelOff. Check them out at propeloff.com. That's PROPELAUTH.com. Hello, listeners. Today, I'm talking with Dan Iman, the Managing Director at Meld Valuation, specializing in independent, audit-ready valuations for VC-backed startups and VC firms. He is an expert in the valuation of complex instruments such as convertible debt and safes. Dan is going to illuminate the common mistakes of founders, how valuations differ, and what founders should understand about dilution, and how fundraising affects their cap table. Learn more about Meld at meldvaluation.com. Well, Dan, thank you for being on the show today. Thanks for being on Code Story.
Thanks for having me.
Absolutely. Before we dive into our topic today around valuations and equity and all things you're going to bring to the table, tell me and my audience a little bit about you.
I'm Dan Iman. I'm the CEO and founder of Meld Valuation. We're a boutique valuation firm based in San Francisco. I founded the firm 11 years ago. We do valuations for a variety of reasons, everything from working with startups to funds to individuals themselves. And we've worked across everything from seed stage companies, pre-seed, to multi-billion-dollar companies going through an IPO. Personally, I'm a husband, a father of two boys. I like to swim, bike, and run. I call myself a recovering triathlete. Triathlon is it's exercise that's lost its mind. And I still like to do those things, just not in that order on the same day.
Okay, so you don't do all three anymore. But of the three, which one is your favorite?
Oh, probably cycling. Love cycling. I still run a couple times a week, but I also love my bike. So I'm a really bad swimmer. I spend a lot of time in the pool, and it's the shortest piece of the triathlon.
Well, that's really cool. Okay, well, let's dive into our topic today. Before we go too far, tell me about Meld Valuation. Tell me about what the company is and what you do there.
We specifically, on the company side, on the startup side, most of the companies we work with are venture capital or private equity backed. We don't do 409A valuations, which is why we have partners in that space, but we do valuations for a lot of different reasons for startups. And that could be convertible debt, could be safes, warrants, earnouts, derivatives, any sort of complex asset that lands on their balance sheet or income statement we can handle. And then on the fund side, we work with venture capital and private equity funds. And that's a whole different thing. So we're valuing their underlying portfolio companies. So you're XYZ Ventures, you invest in a startup, maybe you invest in their Series A, their Series B, and then it's 18 months later and you're closing your books with your auditor, because oftentimes LPs require the GPs, so your limited partners require the general partners to have an audit. Typically, it's a Big Four. A Big Four auditor will say, what's that worth now? What's that Series A worth? And a lot of times they turn to a third party. So that would be us. And then in terms of individuals, we do gift and estate tax work. For founders, that's typically QSBS, Qualified Small Business Stock. New legislation just got passed, which is really interesting, which actually has implications for managers as well, general partners on the fund side. What that allows founders to do is take the first $10 million in proceeds from an exit tax-free. Oftentimes that requires valuation support.
Okay, let's jump into my first question. So when it comes to valuations and equity structuring, founders, they know about their company. They don't know a lot about this specific thing. What are the most common mistakes you see these founders making when it comes to valuations and equity structure?
There's probably 5 or 6 things that I typically see in terms of mistakes around valuation. One of the things I often see is overvaluing too early. So having an inflated valuation in early rounds, it really puts a lot of pressure on downstream rounds. It can create unrealistic expectations and make future rounds really hard. You run the risk of having a painful down round. No one wants to do that, especially on the employee side, right? If you raise a round and you're granting options to employees and you do a down round, you have a political problem internally, because the early employee is going to say, why is that person getting options cheaper than my options? I was here 3 years ago. I think a misunderstanding fair market value is a problem. Just assuming pre and post money values are very simplistic. You just take your fully diluted shares outstanding and divide. That doesn't account for the mechanics of how venture capital rounds work. There's liquidation preferences with safes and convertible notes. You get dilution, but using price per share from a financing for 409A grants, that's not a good idea, right? So if I were a startup, I would use a legitimate third party to get a 409A, someone like Carta. They do a great job. I would say also, just like I mentioned on before, is just ignoring liquidation preferences, right? So founders see a big headline valuation, we're worth X amount of dollars, but they forget sometimes that investors get their money back before they get any money, right? And that happens quite often in exits. You get a moderate exit and the common shareholders don't see a dollar. And then I think the other two that I see quite often are just using wrong valuation methods, applying public comps too early, or VC pricing logic, where maybe a hybrid method or something else would work a lot better, make a lot more sense. And then I would say lastly, what I see constantly these days is assuming that your valuation cap in your safe is your valuation for your company, which just isn't the case. A valuation cap, and I can get more into it at some point here in this conversation, but it's essentially downside protection for an investor.
Okay, so you said a couple of things there that I want to dive into a bit, because I think the instruments or the vehicles, or however you want to say it, whatever the word you want to use, can sometimes be confusing, even if you're a founder and have gone through the process. So can you break down how safes and convertible debt actually work? And, over time, how do they impact ownership?
Convertible debts and safes are completely two different things. Sometimes people to call safes a note. A safe is not a note. Let's be clear. It's a simple agreement for future equity. It was developed at Y Combinator. And convertible debt is just that. It's debt. It accrues interest. It has a maturity date and has recourse for the debt investor. There's no recourse with a safe. And then you have two different kind of flavors of safe these days. Safes are by far and away the most popular these days. You have a pre-money safe, which was developed by Y Combinator, and you have a post-money safe, which was later developed by Y Combinator. But how they work, the conversion mechanics are pretty similar with both convertible debt and safes. You're an investor, you invest in the startup, whether it's a safe or a convertible note. And typically what happens is with convertible debt, it accrues interest, but with safe, it doesn't. There's no interest, but it converts into the next round of qualified financing. And a qualified financing is typically a priced preferred round. And it usually converts at a 20% discount. You convert it at 80%, essentially, if you want to think of it that way too, right? So you get more shares than you would if it was just 1-to-1 on the price round. Oftentimes you have provisions in both convertible notes and safes upon an exit. The investors can typically take a multiple on their invested money, or they can convert it into common. And then what happens in an exit is when you converted everything into common, everything just gets allocated based on the percentage ownership. Safes are founder friendly. They're super flexible. I would say these days, post-money safes are in vogue and probably the most used. And what that means is that the dilution is fixed when the safe is signed. So you're using a post-money cap table based on your next financing. So the post-money, when you run these dilution calculations, is factored in. But that's not the case with a pre-money safe. It depends on the future round size and the terms. Same goes for convertible debts. They often have valuation caps. And what that means is that if you're a startup and you go raise at, let's say your valuation cap is 10 million and you go raise at 20 million, well, that safe or convertible note converts at that $10 million valuation cap, not at the 20 million. And that's why it's downside protection for the investor.
Right. Okay. So that makes sense. I appreciate you clarifying the different mechanisms. I want to go back to the point you made about the evaluation gap. Can you describe that a little bit? Founders are misconceiving that as their valuation. Tell me a little bit about that.
What I see, and I'm sure what other people see often, is successive valuation caps. So the company may have a rolling safe that's open and they're raising. Typically what I see is startups that raise money throughout time. Maybe it's over a year, sometimes even longer. And the valuation cap keeps getting bigger and bigger. It goes from 5 million to 10 to 20 to 25. And why a valuation cap is not an actual valuation. It completely ignores market dynamics, product traction, just anything where I would think of it as where I would say, why isn't it a valuation? It's a contractual term. It's not a valuation. No one's actually looking at the company, looking at the fundamentals and coming up with an independent third-party valuation. A startup may issue different safes to different investors at the same time based on the negotiations that happen there. That can be conflicting and illogical. And a lot of times, just to be candid, these valuation caps are pulled out of thin air. Investor A may talk to his buddy, investor B, and say, hey, what was the last cap you did it for this stage of company? And it becomes a chicken and egg problem almost. In valuation caps, they don't reflect current market conditions. It's what investors are willing to accept, not the company would actually be worth if it were to end up in a transaction. So maybe a strategic buyer or an exit. And obviously, or maybe not obviously, but obvious to me, but investors want low caps, right, for higher risk. And they may accept higher caps as that risk decreases. However, the company's fair value may have not necessarily changed in between. And valuation requires kind of formal analysis. And at the early stage, it's hard to do. What's counterintuitive is that the hardest startups to value are the most early stage ones. In conclusion, the cap is used to protect and incentivize investors and may not reflect intrinsic value.
Okay, Dan. So obviously you stay close to this, the valuation part of the industry, which obviously you keep tabs on the VC world as well, and I'm sure private equity and things like that. But I'm curious about VC specifically. What are the general trends in the industry right now? Because from what I can tell, there's some tense times, or there has been some tense times, and I'm curious what you're seeing.
What we're seeing for startups is that pre-money valuations are holding steady. AI is dominating VC dollars. In the first half of 2025, almost 50% of global VC dollars went towards AI startups, which is pretty interesting. I think You're seeing a credit crunch for VC firms. We're also seeing a healthy secondary and exit activity. And IPO and M&A markets are picking up, especially in AI, defense tech, fintech. And I think there's some pretty interesting things happening in terms of technology out there, though, for startups and VCs and private equity. On the VC side, Carta's done a great job in terms of their fund admin. I think that's great. They're also, I think, ever since they sunsetted Carta X, which was their secondary market, they wanted that to be a private market for a stock market for private shares, And I think since they've sunsetted that, they're moving into being an ERP for private capital. And I think that's really exciting. And as they approach the private equity markets, it's not simply a shift away from VC. It's a whole new service offering. And I think that's exciting because they're bringing an innovative set of eyes. There's plenty of legacy systems out there that private equity uses, but I think what we're going to see is Carta do a real great job in that market. And then just backing up a little more, I think there's fewer deals, but bigger checks. Founders need strong metrics. AI is reshaping allocations in both venture and secondary markets, and fund managers are facing pressure. But however, exit liquidity is improving. So that's what I'm seeing.
Right. That makes sense. So then I'm a founder, which I am. I'm a founder, and I want to value my company. At what point should I be thinking about bringing in a valuation firm, bringing in someone who's the expert to come in and help me with this? Because I don't want to do it too early, spend the money on that, or I don't want to do it too late, and do it wrong myself. So when should I be thinking about this?
Most of the time, valuation professionals get brought in when you want to issue stock options. So 409A valuations. That requires a fair market value. So under IRS rules, you have to issue those stock options at fair market value. And there's kind of two standards there. There's fair market value is a tax value, and fair value is your financial reporting value or GAAP value. Both are covered under most 409As. And that's typically when a valuation firm ends up working with a startup. And then after material financing events, same thing, the 409A will get updated. But oftentimes, a valuation firm is brought in, it's typically transactional, right? So whether that's a financing round, an exit, right now I'm working on a company that's spinning out part of their company into a new company, or an M&A event, right? Typically startups aren't asking me, hey, what's my company worth? Investors already have an idea of what it's worth, and they're going to have their own return requirements, their own thoughts around how to approach valuation. So a lot of times valuation firms are brought in around GAAP compliance, tax compliance, and then in exit or spin out scenarios. And a lot of times we're foisted upon people, right? So you get to a Series B, right? And you do your Series B, and the Series B investors say, listen, we're going to require you to start auditing your financials. And the auditor will say, you need to value this convertible debt that's on your balance sheet. You need to value these safes. You can't just carry them at cost. And then I end up talking to you.
Right on. So that also makes sense, and that registers there. But also, it's the course of doing business. You have to know what those things are worth, and if they're on the books and people need to have a dollar value to them, then that makes sense. That registers with me.
Yeah, 100%. And just one more thing, the reason why 409A is important, a lot of people dismiss it, right? And they're like, oh, it's silly, it's dumb. Why do I have to do this? And I'll tell you why. Because when you get to the Series B, C, when you get to an exit, the auditors are going to look at those 409As. And if they won't accept them, you're going to have to redo them, and you're going to have to reprice options. And it's painful. I've done 409As where they need them in 3 days because there's an LOI signed and they want to exit. That's an expensive 409A.
Yeah, I'd imagine so. Okay, so then you mentioned 409A, and then, I've heard the terms of the ASC 820. How do they differ, and why? Why do these specifically matter for VC-backed companies? And I think you mentioned for the 409A, why that part matters, and maybe it's the same for the 820, but why are they different?
409A is always at the company level. That's for tax compliance, GAAP compliance for ASC 8718, which is your stock option expense calculations. It's the fair market value of the common stock. That's the output. ASC 820 is pretty broad, covers a lot of ground, but in the startup and VC space, that's at the fund level. That's your investors. So it's the fair value of the portfolio holdings or the securities they hold. And the standard of value there is not fair market value, so what an IRS agent would think about or tax matters, but an exit price in an orderly transaction. Here's the thing with 409A. I used to do a lot of them, but I don't anymore. But the whole goal is to be low and defensible, right? at any given time, a company has a range of values, right? And on the left-hand side is our 409A value. We want to grant stock options at the lowest possible value that's still defensible. That aligns the incentives of the optionee to the incentives of value creation for the company. And on the right-hand side is the value we want to go raise money at, right? Think of it as a bell curve. And ASC 820 aims to be in the middle for the investor. So that's the value they're putting on their books for their holdings. And depending on the investor, they may do that once a year, they may do it quarterly. And to be honest, it's far more reasonable. With the auditors, it's more of you have to think more like a VC and less like an employee who wants a low option price.
So then, valuations, funding, raising money, the other term that comes up is dilution, right? For founders. We want to dilute as little as possible always, right? But we need to understand that it's important and it's a part of fundraising. What should founders understand about dilution and how these rounds affect their cap table, long term?
Every time a company issues new shares, it reduces the ownership percentage of the existing shareholders, right? It's a natural part of fundraising, but unmanaged dilution can leave founders with much smaller stake than they expected. Just in case people don't understand, every time you raise capital, new investors receive equity in exchange for that cash. This increases total number of shares, and existing shareholders now have a smaller percentage, right? So you're a co-founder, you each own 50%. You need to raise a seed round and issue 25% of your equity to investors. Now you each own 37.5%. And this continues each round, right? And the cumulative dilution can add up. Typically, what I see in terms of dilution is 50 to 60% holdings after seed, 30 for founders, 30 to 40% after Series A, and 10 to 20% after Series C or D. And this is normal. Your stake is still worth more because the valuation of the company is growing, right? And so focusing on just percentage and not value is a mistake, right? I'd rather own 10% of a $500 million company than 100% of a $5 million one, right? Yeah. Over-equitizing advisors or early hires, I see that sometimes, giving 5% to someone who worked part-time for 3 months. That's a mistake you'll regret. Ghost founders is a problem. Two buddies start a company. It's great. And then one of them is gone, but he still owns 50% of the company. That's a problem. You have to model your cap table scenarios, and there's great tools out there to do that. A lot of founders have no idea how that safe note, especially when they're stacking them, and then the subsequent price round will affect their cap table later. And if you're a founder and you don't know how to do that, ask someone to help you or use some of the tools out there that exist. And underestimating the impact of the option pool expansion. VCs will require expanding the pool before their investment, meaning the dilution hits you, not them. And you need to model your cap table fully when you think about safes, notes, future rounds. Negotiate cap-friendly terms. Post-money safes are the way to go. Lock in your dilution. And use equity strategically. Align grants with value creation, like I talked about early. Use vesting, refresh and protect your cap table. And then finally, I think another thing that founders need to think about is what a waterfall model is and how it works to see what each stakeholder gets at different exit values, right? So a waterfall just calculates the way the proceeds are distributed across preferred and common stock based on their liquidation preference, participation rights, and conversion features. Dilution's inevitable, and that's fine. But being surprised by it is not. You don't have to be surprised by it.
Sure. This seems like something you'd have to keep your finger on the pulse of on a regular basis. When you mentioned the percentage differences of ownership on the different series, you said Series A and then you went to C and D. Is there a reason you didn't mention Series B? Is it not that different from Series A?
There's not great data that I have on it. Series B is not that much different. We do have good data in terms of valuation pre and post around Series A and B. But in terms of percentage ownership, it's pretty similar to A. You can step it down even a little from A. Instead of 30 to 40, maybe you're 20 to 30 in there.
Okay. So you've worked with thousands of startups, right? You've been around the block with these folks, done the valuations, taught them how to think about this. What separates those who scale successfully from those who stall? Because, if we're in this journey and we're backed by a VC and we're trying to scale, or really we're backed by VC, it could be any sorts of numbers of entities there. What separates the wheat from the chaff for those who scale successfully?
I would say number one is relentless focus on fundamentals. So understanding unit economics and understanding your business drivers, not vanity metrics, and knowing how to say no. Even in my business, it's important to know what you don't do because it's tempting to say, oh, we could do that. Leadership obviously is, I think, important. Founders who know how to delegate and align a team around goals. I think that's really important. And these days, I can tell when I'm talking to someone if this person's a leader or if this person will eventually get replaced, right? I've seen that in board decks where one of the line items is talking about replacing the CEO. Using capital really smart. We talked about dilution and rounds and valuation. And the best founders out there know the right amount at the right time, right? You don't want to take too much money too early. Building leverage and knowing when to raise and from who is important. And I guess there's probably a couple more things. One is an obsession with customers or product. The best startups talk to customers all the time. They build around their pain points and their behavior, not founder preferences, and they iterate fast, right? Fail fast, that kind of thing. And they don't confuse motion with progress, right? Just being busy is not progress. The best founders have scalable systems and repeatable processes, right? So they're building standardized systems instead of just building projects. I guess the last one is more of just, and this is anecdotal, but having worked with and talked to so many founders, I find that the best ones, one, are humble. They have humility. I've talked to plenty of arrogant founders and things didn't go well for them. And then grit, keep going the best founders keep going when it's hard. Their attitude is not, oh, that didn't work. It's, that didn't work yet. And when the going gets hard, they know how to adapt or they know how to figure it out. The worst founders just say, I don't know how to do that. And we'll figure it out. And I think about myself too. Granted, I'm not a technology-based startup, but I have mentors in my life. One of my mentors, Chad Wilbur, he's a vice president at Carta. He taught me how to do valuation. And then I have other mentors as well, both personally and professionally.
Awesome. Well, Dan, I really appreciate you being on the show today. You've really highlighted some things for me and for the audience around what's important for founders to realize when it comes to valuation structuring and their equity. You explained the different mechanisms and the valuations and how they differ and when it's important to bring in a firm like yours. And I'm certain that the founders that listen to this show have learned a lot about the pieces that need to go into it and the pieces they need to keep at the forefront of their minds as they're running their startup. How can founders and startup builders reach out to you and get more information about Meld Valuation?
Yeah, absolutely. I can always be reached at dan@meldvaluation.com, or you can go to our website. I'm very accessible and I'm quite easy to work with. I'm always happy to talk to people. I do a fair amount of just education sometimes. One of my goals is to be of service both personally and professionally. I try to embody that when things come
Fantastic. Well, Dan, thank you again for being on the show.
Yeah, thanks for having me.
Dan clearly knows his stuff and definitely helped me to see the common mistakes by founders, and specifically how the mechanisms differ in this arena. Founders need to understand the terms of the space, the terms of their deal, and how one differs from the other as to how they can positively and negatively affect the perceived value of their company. If you'd like to learn more about Meld Valuations, check out meldvaluation.com. And thanks again for listening.
Warning, the following ZipRecruiter radio spot you are about to hear is going to be filled with F-words.
When you're hiring, we at ZipRecruiter know you can feel frustrated, forlorn even, like your efforts are futile, and you can spend a fortune trying to find fabulous people, only to get flooded with candidates who are just fine. Fortunately, ZipRecruiter figured out how to fix all that. And right now, you can try ZipRecruiter for free at ZipRecruiter.com/zip. With ZipRecruiter, you can forget your frustrations because we find the right people for your roles fast, which is our absolute favorite F word. In fact, 4 out of 5 employers who post on ZipRecruiter get a quality candidate within the first day.
Fantastic.
So, whether you need to hire 4, 40, or 400 people, get ready to meet first-rate talent. Just go to ZipRecruiter.com/zip to try ZipRecruiter for free. Don't forget, that's ZipRecruiter.com/zip. Finally, that's ZipRecruiter.com/zip.
You just realized your business needed to hire someone yesterday. How can you find amazing candidates fast? Easy. Just use Indeed. Stop struggling to get your job post seen on other job sites. With Indeed sponsored jobs, your post jumps to the top of the page for your relevant candidates, so you can reach the people you want faster. According to Indeed data, sponsored jobs posted directly on Indeed have 45% more applications than non-sponsored jobs. Don't wait any longer. Speed up your hiring right now with Indeed. And listeners of this show will get a $75 sponsored job credit to get your jobs more visibility at Indeed.com/PODKATZ12. Just go to Indeed.com/PODKATZ12 right now and support our show by saying you heard about Indeed on this podcast. Terms and conditions apply. Hiring? Indeed is all you need.